HatchnEgg is a lovely company question, and it is a combination of companies, tax calculations, dividend calculations, as well as a change in estimate. HatchnEgg is a well-known company situated in Gauteng. The company was incorporated on 1 October 2012. It's in the business of supplying free-range eggs to the South African resident companies such as Willis Limited and P&P Limited. HatchnE becomes a value-added tax vendor on 1 December 2014. HatchnE was incorporated with the following authorized share capital. 4 million ordinary shares, note 1. This is all about ordinary shares. 1 million 15% compulsory convertible non-cumulative preference shares, note 2. And 500,000 11% compulsory redeemable cumulative preference shares, note 3. Now, the following share transactions took place after incorporation. So not in the current financial year, after incorporation. Now, let's just quickly find out what they want from us. Prepare the statement of changes in equity for HatchnEgg for the year ended 30 September 2017. The total column, comparative figures, accounting policies, and notes to the financial statements are not required. So if they're going to give us all the share transactions since 1 October 2012, make sure that you group together those that happened in previous financial years separate from those that happened in the current year. So firstly, let's just check, when did our financial year, when did it start? Let's just write it here for us. Our financial year started on 1 October 2016 and it ends on 30 September 2017. Very important that you see that for this purpose of this question so that you can group your stuff correctly. So there's our financial year. Right, now another thing that is important in this question, let's just say this is all the ordinary share transactions grouped together. This is all the compulsory convertible cumulative pref shares grouped together. And here number 3 is all our compulsory redeemable pref shares grouped together. Make sure you see that there is dates all over the show. Make sure that you do your transactions in date order, because this is one of those questions, if you didn't follow the date order, your answers would have been totally wrong. Good, so let's start. On 1 October 2012, 700,000, that was the initial issue, 700,000 shares were taken up by the public. On the same date, another 100,000 ordinary shares in total were taken up by the 2 directors of HatchnE. In terms of the shares issued to the public, 20% were issued to South African registered companies. All ordinary shares issued on 1 October were issued at 18 Rand per share. So we can quickly work out what was the shares at that point of time. It's 800,000 shares at 18 Rand a share, and that then equals 14,400,000. Then the first other one that happens is on 1 September 2017. The directors, after the decision was approved by special made and a capitalization issue of 2 ordinary shares for every 20 shares held at 30 Rand per share. Now, let's do the date story as well, that is important. 1 September is in the current financial year. So therefore, our opening balance for ordinary share capital in statement of changes in equity will be 800,000 shares at 14.4 million Rand. So 800 shares times 18 Rand, opening balance 14.4 million Rand. Now, let's park the current year's transactions a little bit so that we can find out whether there wasn't another transaction in the current year that could have impacted on this transaction which happened on the 1st of September. 15% compulsory convertible non-cumulative pref shares. On 1 December 2015, 600,000 15% compulsory convertible shares were issued to the public at 28 Rand per share, nominal and fair value. So 1 December 2015, let's check our dates, that is a previous year. So 600,000. You'll see there's a lot of information about the shareholders. I think initially the creator of the question wanted to ask dividend withholding tax, and then she ran out of marks and she didn't come around to ask that. But for your own purposes, you might as well work out and see whether you can get to dividend withholding tax. What was the amount applicable to the current year? So 16.8 million rand on that date. Then on 1 July 2016, the remainder of the authorised 15% shares were issued at 30 Rand per share. Now let's check the date. 1 July 2016, current financial year? Also previous financial year. So this share issue, the remainder, initially it was 600,000. We are authorised to issue 1 million. So now we're going to issue the other 400,000 also in a previous financial period times 30, and that then gives us an opening balance, part of our opening balance of 12 million rand. Guys, if you did not do these two together and you did not treat it as an opening balance altogether, you would have lost a lot of marks, at least 50% of your marks. So your opening balance as at the 1st of October was the 16.8 million plus the 12 million, which in total gave you 28.8 million. And then we get to our compulsory redeemable shares. Oh no, before that. On 1 August 2017, 60% of the compulsory convertible shares issued at 1 December 2015, so it was this issue here, that 16.8 million, was converted into ordinary shares at a conversion price of 30 Rand per ordinary share. So the first thing that you have to find out is, when did it happen? On the 1st of August 2017. Was that in the current year? Yes, for sure it was in the current year. Well, now it was converted into ordinary shares. Obviously, this was something that happened, or it was originated by the conversion of the pref shares. But that 1 August is before September, and this converted shares is going to have an impact on this transaction on the 1st of September. So let's do the conversion first, and then we can go back to the 1st of September. Great. So 60% of 16.8 million gives us the value of the pref share capital which was converted, and that is 10,080,000. So the value of the ordinary shares which was issued at that stage was equal to 10.08 million rand. Those ordinary shares were issued at 30 Rand per share, divided by 30 Rand a share. So how many ordinary shares was issued in order to make good this conversion of the pref shares? Remember what happens? These pref shares are cancelled now. So these shareholders are no longer preference shareholders. So in return for their previous shareholding, preference shareholding in the company, they now receive ordinary shares. And they're now going to receive 336,000 ordinary shares at 30 Rand a share. That makes up that value of 10,080,000. So let's do the conversion first on a statement of changes in equity. On 1st of August 2017, I just want that one, the date, we have converted 10,080. Now remember, with a conversion, we only move one type of capital into another class of capital. So whatever we're going to take out here as pref share capital, we're going to include in our ordinary share capital. So it's just a move. And there I tell you 336,000, and this was 60% of that first issue of 16.8 million on the 1st of August. Then the capitalization issue took place, and that took place the 1st of September 2017. So very important there that you see that this happened after that conversion took place. So let's go back to that capitalization issue. On 1 September, the directors, after the decision was approved by a special resolution, made a capitalization issue of 2 ordinary shares for every 20 shares held at 30 Rand per share. HatchnEgg decided to finance this transaction out of retained earnings. Now, the first thing that you should understand is that for a capitalization issue, in this case, they haven't raised, well, capitalization issue, they never raised fresh capital. So, no fresh capital was actually raised. No fresh, well, capital was raised, but cash wasn't raised. Let me just correct myself. No cash was received with this capitalization issue. So what did they do? They had excess monies in the retained earnings, and they decided that they're going to give some of that retained earnings back by ways of additional shares that they're going to issue to the shareholders. So how many shares do they have at that stage? They have 800 shares there, plus 336,000 shares here. So it's the 800,000 shares there, plus the 336,000 shares which was issued with the conversion of the pref shares. And that is the number of shares. So for every 20 shares divided by 20 then, the shareholder is going to receive 2 ordinary shares multiplied by 2. So they are going to issue here 113,600 ordinary shares. At what price? The question tells you the value placed on those shares was 30 Rand per share. So the value times 30 is going to give us a total of 3,408,000. Then the question also says that HatchnEgg decided to finance this transaction out of retained earnings. Now, if it was out of retained earnings, it means I have to capitalize some of my retained earnings as share capital. So I'm going to take out of our retained earnings that amount of 3,408,000, which equals 130,600 shares multiplied by 30 Rand per share. So I take it out of retained earnings, I put it into share capital. Can you see that nowhere is a bank transaction involved? So there's no cash flow that the company can benefit from. All that's going to happen, it actually capitalized, it made some of its retained earnings, it converted that into shares. Right, then 11% compulsory redeemable cumulative pref shares. On 1 January 2017, when was 1 January 2017, guys? Very important. It was in the current financial year. On 1 January 2017, 200,000 11% compulsory redeemable cumulative shares were issued at 15 Rand per share and were taken up by the public. These issued shares are redeemable in cash on 31 December 2022, about 5 years thereafter. 100% of the compulsory redeemable cumulative pref shares were taken up by the general public, all South African residents. On 30 September 2017, year end, a dividend of 297,000 was declared for these shares. So they give you the dividend, you do not have to prove them wrong and to rework that. But what is this dividend now? This dividend is interest. So in your income statement, you have to make sure that you have provided for that interest of 297,000. Compulsory redeemable cumulative pref shares is not equity, and if you did show it in your statement of changes in equity, -2 marks on the spot. The following balances were disclosed in the financial records of HatchnEgg as at 30 September 2016. So this is our opening balance. Revaluation reserve 500,000, and retained earnings 10.845 million rand. So retained earnings and revaluation reserve, there it is. Then the following income and expense items incurred were correctly classified, and they start with revenue, cost of sales, and it's all income items, distribution expenses, administration expenses, other operating expenses, and then they give you a preliminary profit before tax figure of 2,350,984. The accountant calculated the preliminary profit before tax but did not know how to deal with the following. Plant with a cost price of 500,000 Rand had an estimated useful life of 5 years and an estimated residual value of 60,000 Rand. This asset was depreciated by applying the straight line method. The carrying value of the plant was disclosed in the previous set of financial statements as 346,000 Rand. Let me see how much space I have here. So here we said, okay, the cost price, was 500,000. Accumulated depreciation, they don't give it to us, but they do give to us the carrying value. And they tell us the carrying value was 346,000. So obviously what we can do here is we can work out what was the accumulated depreciation at this stage. And that was 154,000 Rand. The financial director approved the proposal not to depreciate the plant over 5 years, but that 4 years would be a better estimate on the total economic life years. The residual value was not changed. The South African, the entity adopted the cumulative catch-up method for recording any changes in estimate. Depreciation for the current year must still be taken into account. Good, so cumulative catch-up says I have to start all over again and I have to rework all my depreciation up to the beginning of the current financial year to work out my catch-up depreciation, and then I have to work out my normal depreciation. But let's just check here. What was our previous depreciation write-off per year? It's 500,000 less the estimated residual value of 60,000 divided by 5 years. And that gave us a depreciation expense of 88,000 Rand per year. So if we want to see how much of the lifetime of the asset is actually now gone up to the beginning of the current financial year, then I would say 154,000, the accumulated depreciation, divided by 88,000 Rand. That will tell us how much of the lifetime of the asset has already expired, and that is 1.75 years up to the beginning of the new financial year. So if we're going to do the new method, we're going to say, well, the cost price is going to be 500,000. Our accumulated depreciation is going to be what? It's going to be 500,000 less the residual value stayed the same, but the lifetime of the asset has changed to 4 years. So we are going to write off 110,000 depreciation in the future. So that means that our accumulated depreciation at the beginning of the year would have been, I'm going to write it here, 110,000. What is the time that has expired already? Up to the beginning of the year? 1.75 years. So 110,000 multiplied by 1.75 would have given us an accumulated depreciation of 192,500 rand. So that would have given us a carry value of the asset as at the beginning of the year, if we did apply the new method from the start, of 307,500. So what is our catch-up depreciation? That is the difference between the 154,000 and the 192,500. So, oops, that should not happen. So what is our catch-up, guys? Our catch-up is then the difference there between the two, and that is equal to 38,500. I'm not going to get it out there. Just say catch-up. What is our actual depreciation for the year? Our actual depreciation for the year is 110,000 rand. There we've worked that one out. 110,000 rand. So let's do that one in green. Let's do that one in green. So what is going to be our total depreciation for the year? 38,500 plus 110,000, which equals a total of 148,500. Great. So therefore, we have to adjust our preliminary profit before tax with this amount of 148,500. There's a sentence that I haven't read. SARS allows wear and tear over 4 years on the cost price of the plant with no estimated residual value taken into account. So what is going to be the wear and tear then? That is going to be 500,000 over a lifetime for 4 years, no estimated residual value. So that's going to be our wear and tear allowance of 125,000 rand. The accountant that prepared the preliminary profit before tax did not take into account any matters where applicable that relate to share capital. On 1 July 2017, HatchnEgg issued 20,000 12% debentures at a nominal value of 300 Rand per debenture. Now let me tell you about debentures. I have already told you about debentures in another video, which I've explained, so if you've missed that. Debentures is loan capital. Instead of just borrowing money from one single source, I'm going to issue a debenture, which means that the holder of the debenture is actually providing me with loan finance. So if I want to raise a large sum of money and the risk involved in providing me the finance is too big for one guy to carry, then I issue debentures. And then a lot of guys who is able and who wants to take the risk actually takes up a debenture. Now, a debenture has a nominal value attached to it. In this case, the nominal value is 300 Rand per debenture. So the value of those debentures that was issued was 20,000 debentures at 300 Rand a debenture, which gives you then a total of 6 million Rand. Now, I can issue debentures at a premium and I can issue debentures at a discount. I will not require from you to record the issuing of debentures at a premium or a discount. I can require from you, though, the issuing of debentures at a nominal value, which you have to disclose in the statement of financial position. And in your statement of financial position under non-current liabilities, you would have said a long-term finance debentures issued, and you will then mention in that note the full particulars of the debenture. 20,000, 12.5% debentures of a nominal value of 300 Rand each, and you will have to note when that was issued, and you will have to note exactly what is the repayment terms, like any long-term loan on that debenture. However, for income statement or income tax purposes and income statement purposes, I can give you a debenture which was issued at a discount or an issue at a premium. What I want to test there is that you know that the interest on the debenture is always based on the nominal value of the debenture. It does not matter whether that debenture was issued at a price higher than the nominal value or lower than the nominal value. When we work out interest, interest is worked out on the nominal value. So in this case, 6 million Rand. The interest then is at 12.5%. And the period that is always like fine, it's a loan. So it works like a loan. So it was issued on the 1st of July. So from the 1st of July to the 30th of September was a 3-month period. So the total interest that we still have to take into account equals 187,500. The accountant did cross-reference the depreciation methods applied for accounting purposes to that of wear and tear methods as allowed by the Income Tax Act, and it was found to be the same, except as mentioned in the above-mentioned paragraph that deals with plant. So what it says is that the way that we calculate tax and or profit before tax, and the way that the receiver of revenue is calculating taxable income is exactly the same, except for this one here, where he is going to give you a different wear and tear allowance as to the depreciation that you are going to recognize in your accounting records. The income tax rate for companies is 28% and dividend withholding tax is 20%. During the current financial year, 2 provisional tax payments were made. Payment 1 and payment 2, and you now take these payments to the income statement and is -5 marks on the spot. Because provisional tax goes against the receiver of revenues account. What goes against the income statement account? The income tax charge for the year, i.e. my total liability for the year, which I calculate based on 28% of my taxable income. That is going to the income statement. Provisional tax payments is a prepayment that I've made on my taxes for the current year. Good, then on 29 September, dividends were declared as follows. Now, before we get to the dividends, let's finish off our net profit story. Let's just go back here to this long income statement that I gave us. And let's run through it. Interest income, profit on sale of machinery, credit losses recovered, and then we have dividend income. Dividend income, why did I color it in? Because it's not subject to normal tax. Depreciation on vehicles, packaging materials, salaries to staff, fuel and other related vehicle repairs, toll fees, traffic fines. Why do I highlight that? Because it is not a tax deductible expense. Rent expense, director's remuneration, audit fees, salaries, telephone, water, electricity, insurance, depreciation on office equipment, repairs and maintenance, inventory write-down, penalty on the late submission of the VAT return, not a tax deductible expense. Right, so let's go and determine our actual profit after tax for the year, and we will start then with our preliminary profit before tax, 2,350,984. The first thing that we haven't accounted for against profits is my interest on my redeemable cumulative preference shares, and there they gave us that amount, 297,000 Rand. The next thing that we haven't taken into consideration in our profit figure is our depreciation charge for the year of 148,400. So let's go and determine firstly what is our actual profit before tax, because our actual profit before tax is also our starting point for our tax calculation. So we start with our preliminary profit. We're going to deduct that actual depreciation on the plant of 148,500. We're going to deduct the interest on the cumulative preference shares, and we're going to deduct the interest on the debentures. That 187,500, we're going to deduct that as well. So if we go back to that 297,000, it is the depreciation there of 148. It is another 187,500 worth of interest. And that then gives us our adjusted profit before tax of 1,717,984. And guys, then we park that figure. That is in our income statement. Profit before tax, 1,717,984. Then you take out a piece of paper. And now you're going to do your tax calculation. Now you start your tax calculation with that profit before tax figure. Where's my profit before tax? Profit before tax figure, and that is this one here, 1,717,984. 1,717,984. Now I can deal with all these items that I've identified, which is either not a taxable income or not a tax deductible expense. Dividend income of 18,000. It's not subject to tax. So what I'm going to do is I'm going to deduct that dividend income from my profit before tax. There it is, 18,000. I'm going to deduct that because it's not tax deductible. Oh, it's not taxable. Traffic fines is not tax deductible, so I'm going to add it back to my profit. And the same thing applies to the penalty on the late submission of our VAT return. I need to add it back to my profit. So there I add back the fines. Here I add back the penalties. Now remember, when we did this calculation, we took our actual accounting depreciation in order to derive at our actual accounting profit, 100% correct. But now the receiver of revenue does not recognize the 148,500 as a tax deductible expense. So therefore we're going to add the 148,500 back again. And then we have to deduct the wear and tear allowance. Now we've calculated the wear and tear allowance. There it is, 125,000 rand. So here we're going to subtract then the wear and tear allowance of 125,000 to derive at our taxable income. Guys, I cannot stress this enough. This is only a calculation. This does not appear anywhere in your books. You do not carry on. Once you have calculated the 1,717,984, you do not carry on doing this. This got absolutely nothing to do with your income statement. The whole purpose of this calculation is to calculate my tax for the year, because that is the only thing, only this one, that will go to my income statement. So that is the figure that I'm after. That is the reason why I do this. Oops. So that 490,766, which equals 28% of my taxable income, that will go to my income statement. So my profit after tax, I actually want to copy this back here. My profit after tax is now going to start there. Profit after tax, 1,717,984. Less taxation, 490,976. Profit after tax, 1,227,008. So please, I've seen this so many times before, where you do this simple, stupid thing by getting to your profit before tax and then you just merrily carry on. This one is only a calculation to get to my taxation charge for the year, 490,976. Then I use that 490,976 in my income statement as my tax. So and profit after tax is then going to be 1,227,008. That is also the figure that will be reflected on the statement of changes in equity. Total comprehensive income and the retained earnings 1,227,008. Now we can do the dividends. On 29 September, the dividends were declared as follows. Ordinary dividends of 300 cents per share, 15% on the compulsory convertible non-cumulative preference and 11% on the compulsory redeemable cumulative shares. Now, this is already been, this is the 297,000 which we have already accounted for. Which they've given us. Okay. So let's do on the ordinary dividends. Again, now it's easy. If I go to my statement of changes in equity, I have 800,000 there. I have 336,000 there. I have 113,600 there. So how much dividends do I have in total? Where do I get here? I have in total 1,249,600 shares multiplied by 3 Rand dividends per share, and that will give us total ordinary dividend of 3,748,800. If I want to look at my convertible pref shares, in issue 28.8 million Rand up to the 1st of August 2017 at a 15% dividend rate. So 28,800 times 15% for 10 months will give us 3.6 million. Then what happened? I converted 10,080 and on the 1st of August, and from the 1st of August up to the end of the year, I had 18,720,000 capital 15% for the remaining period, where I'm going to calculate for the remaining 2 months my dividend at 15%, 468,000. Guys, there are many ways to skin this cat. At the end of the day, your answer must be 4,068,000. Total dividends is then the 3,748,800 plus the 4,068,000, which gives you a total of 7,816,800. Dividends 7,816,800. You are allowed to split your dividends on the statement of changes in equity between ordinary dividends and cumulative and pref dividends, or you can show that on a one-line item. The choice is yours.